Understanding liquidity preference theory, an overview. Liquidity preference theory is a critical framework in economics that explains how individuals and institutions make decisions regarding cash and liquid assets. This theory, articulated by the renowned economist John Maynard Keynes in his influential work The General Theory of Employment, Interest, and Money, in 1936, emphasizes the important relationship between liquidity, interest rates, and the overall economic environment. Key principles of liquidity preference theory. 1. Basic concept. Liquidity preference theory suggests that people prefer to retain assets in a liquid form, such as cash, rather than investing in less liquid options, like stocks, bonds, or real estate. This preference is driven primarily by uncertainty regarding future financial and economic conditions. 2. Interest rates and liquidity. One of the central tenets of this theory is that interest rates adjust to balance the desire to hold cash against the willingness to invest in less liquid assets. When liquidity preference is high, interest rates must rise to incentivize individuals to sacrifice liquidity for potential returns from illiquid assets. 3. The trade-off. Investors face a trade-off between holding cash, which offers high liquidity but generates no return, and investing in illiquid assets that provide interest but are less easily convertible to cash. This dynamic creates an essential interplay between liquidity preferences and prevailing interest rates in the market. How does liquidity preference theory work? At its core, liquidity preference theory seeks to explain how the supply and demand for money influence interest rates. Keynes posited that economic uncertainty. During times of economic unease, individuals and businesses tend to prioritize liquidity, leading to a demand for cash and cash equivalents. This behavior necessitates higher interest rates to encourage a shift toward illiquid assets. Liquidity demand. Demand for liquid assets varies depending on people's needs for transactions, emergencies, and speculative opportunities, which are categorized into three primary motives. Transactions motive, the everyday necessity for cash to manage regular expenses. Precautionary motive, keeping funds available for unexpected events or emergencies. Speculative motive, maintaining cash reserves to capitalize on potential investment opportunities when conditions present themselves favorably. Yield curve and liquidity preference theory. The concept of liquidity preference theory is closely tied to the shape of the yield curve, which illustrates the relationship between interest rates and bond maturities. 1. Normal yield curve, generally slopes upward, indicating that longer maturities offer higher interest rates. 2. Investment behavior. When liquidity preferences are high, demand for short-term securities increases, thereby lowering short-term interest rates as their prices rise. In contrast, investors demand higher rewards, i.e., interest rates, for locking their money into long-term securities due to decreased liquidity. Changes in liquidity preferences, such as those experienced during recessions, can shift the yield curve. A rise in liquidity preference may cause a flattening or inversion of the curve, signaling economic distress. Implications for investors. Liquidity preference theory can profoundly inform investment strategies. Understanding this theory helps investors assess their asset allocations and tailor their investments based on changing liquidity preferences. In times of economic uncertainty, investors might lean towards holding cash and short-term assets to maintain flexibility and security. When stability returns, investors might feel more comfortable diversifying into higher yield, illiquid investments as confidence increases. Additionally, employing strategies like laddering investments can help balance cash flow and liquidity needs. Criticisms of liquidity preference theory. Despite its foundational status in economics, liquidity preference theory has faced criticism. Simplification. Critics argue that the theory overly simplifies the myriad factors influencing interest rates beyond just liquidity, including inflation, credit risk, and market expectations. Passive nature. The theory has been criticized for suggesting that the interest rate simply adjusts to changes in liquidity preference, without considering more active interventions, such as monetary policy actions, from central banks that can directly influence interest rates. Conclusion. Liquidity preference theory remains a critical lens through which economists examine the interaction between liquidity, interest rates, and economic stability. Its emphasis on human behavior regarding cash and investments provides valuable insights for investors and policymakers alike. A sound understanding of liquidity preference can facilitate more effective asset allocation and informed responses to changing economic conditions, ultimately contributing to better financial decision-making and economic policy formulation. In a world characterized by financial complexities and uncertainties, liquidity preference theory offers a robust framework to help navigate the often turbulent waters of financial markets. By comprehensively understanding liquidity preference theory, we can better appreciate its fundamental role in shaping economic and financial landscapes.